To invest or not to invest? That is the question that I'm sure is on a lot of people's minds. You're listening to the Investing Mastermind Podcast. I'm Michelle Markey.
And I'm Signe Lundholt.
And the reason we say to invest or not right now is because we're probably hitting a bit of an inflection point in at least the American economy, because as many people know, the American economy is kind of a big deal and it somewhat influences the rest of the world in a financial way. So based on whatever the US doing, that can cause a lot of ripple effects throughout the world, especially when it comes to things like interest rates. So we've talked about the subject of investing in the stock market or putting your money more in high yield savings accounts, but there could be potential changes in the nearby horizon. So that's why we figured we'd talk about this again. It's June of 2024, and there are some recent reports that suggest that change could be coming up soon. And before I go further, Sina, have you observed any kind of news that makes you think things could be maybe changing in interest rates or the stock market? What are some of your high level thoughts before I jump into a lot of fun facts?
Well, there's a whole lot of speculation about interest rates, going down. It's something that's being talked about also, especially here in Europe, where, you mentioned in the introduction that a lot of countries in the world are following whatever US is following, and Denmark is the same. We're looking towards the US to see what is the Federal Reserve going to do about interest rates. So there's a whole lot of speculation here that next time interest rates will be adjusted, they potentially would go down, which is also, one of the things that we're going to talk about today, because what are we going to do? What could we do right now, maybe to get ready for something like that? What could happen if interest rates are being adjusted to lower rates than we see today? What's something that you as an investor should be mindful of if that happens? So yeah, that's the reason why we're discussing it right now.
Yeah. And for example, there's been some reports that suggested from the US Commerce Department that inflation may have been heading closer toward the Federal Reserve's 2% inflation target based on the Personal Consumption Expenditures Index, which is a lot. So it's known as PCE, and that's the inflation measure that the Fed actually cares about. I know the media always talks about consumer price index inflation, CPI, but that's not really the one that the Fed is trying to get toward. So even if it's good or bad, whatever the CPI is doing, the PCE is the one we should all be paying more attention to. And so far, that's been kind of trending a little down, because in January and February this year, the PCE had only been plus 2.5%, and it actually went up a little bit in March and April at 2.7%. So having the PCE inflation go up a little bit suggested that the Fed holds back. Like, there were some economists who were predicting that the Fed might have already been indicating they could cut rates as early as May this year, and that didn't happen because inflation ticked up a little bit. So all the economists were wrong again, as kind of usual. Like, there's a lot of skepticism about what economists know. And here they just, they like to predict every 6 months and kind of see what's happening. And now their prediction is that maybe the Fed might lower rates in the fall, like as early as September, based on inflation kind of getting reined in. So who knows if that will happen? But it presents a question of, so what do we do if that were to be the case? Like, do we invest more in, say, US Treasury bonds and lock in some of those 5% yields right now? Or do we just continue to invest in the stock market? Because if we play out the scenario where the Fed cuts interest rates because the economy is slowing down, what usually happens if interest rates go down, the stock market goes up. So even though the stock market was already up to date, like 11% in the S&P 500 year to date, could that just make it be rocket fuel when interest rates go down? Now the S&P 500 is going to go to the moon. Who knows if that would happen too? So these are some scenarios to think about of what could happen. What do you think, Sina, about this idea of Should we invest in stocks because we think the market will catapult when rates go down? Or is that all just kind of reading tea leaves? And maybe that's not what we should be letting influence our investing decisions.
For me, it's definitely the second one. We never know the future. We never know what the future holds, what's going to happen. There's a whole lot of people that are always speculating about what's going to happen in the future. But, the truth is we don't know much about it. So some indicators, of course, where we can see, okay, there's some cause and effect, of course, sometimes, like when you look at the, for example, purchasing managers index, for example, what the purchasing or the PMI, what that tells you is the purchasing managers sitting in the big companies in the world, are they actually purchasing goods or are they not? And when they start purchasing goods, what you can then predict in the short-term future is that when they start doing it is because sales are increasing. So there are a few costs and effects, but it's really like super short term where you can see those things where there's certain, indicators of what can happen in the future. But then again, something else could come in and happen. We've been talking in the past about Black Swan events. The pandemic was one of those events where couldn't have foreseen it, couldn't have foreseen the consequences, like of what would happen. All of a sudden, a pandemic comes in and kind of changes, at least for a while, how we do things. And of course, also brought bigger changes in, how we live. But right now, we can't necessarily buy stocks, for example, in anticipation of what would Federal Reserve do in the future. For example, speculating that if the interest rates are, reduced, then we should buy stocks right now because then stocks would go up in September, for example. We can't, at least being Warren Buffett investors, we do not speculate like that. And maybe some other strategies would do that. But, the thing is, we don't know what is going to happen. What we could do right now is potentially, if we want to buy a bond, high yield bond that's kind of also low risk bond, could be the treasury bond or maybe certain kind of mortgage bonds, but again, that's also, we saw that in 2008, that can be risky. But if you can get 5% or more, that could be a good investment because that would, yield you a quite safe 5% per year, at least if it's in US Treasury bonds, which is highly unlikely that you're going to get that. But that's what you could do right now, is to see, okay, are there some high interest rates on bonds that are low risk? And again, mortgage, it's difficult, right? Because we saw in 2008 that what was considered low risk all of a sudden turned out not to be. So how about you, Michelle? What do you think about, is it reading tea leaves? Is it, would you do something right now in the stock market, for example, to prepare for what the Fed potentially would do next time they come out with an update?
I'm along a similar vein as you, Sina. I wouldn't let what the Fed is doing to necessarily influence how I invest. So if I'm going to invest in stocks, it's because I've done my research and homework into those stocks that I believe there's a good investment case. Like I recently invested a lot in a certain stock, not because of whatever I think is happening on a macroeconomic level, but based on the business fundamentals of a particular business that I know a lot about and that I believed, even though it had a bad earnings call, I believe that they will recover, that this is a temporary event that they're going through as a business. And I think they are pretty solid because people will keep consuming this particular product in the foreseeable future. And I think that it was a pretty low risk to me to buy this stock when I think it's on sale. And I think that that's what I base my investment decisions on, is not really on if the Fed's going to cut rates or not. I mean, maybe though, if I do have some spare cash lying around that I'm not doing anything much with, like say a lot of that spare cash was sitting in a money market fund, but the rates will change in a money market fund. And as soon as the Fed starts cutting rates someday, if that happens, then my money market fund could go lower. So that's what some people have been doing ahead of when money market fund rates will change, is they take it out of the money market funds and put it into a treasury bond that locks in a certain yield for the next few years or however long that they've locked it in for. So some people could do that because if you're thinking, okay, rates could change in the next 6 months and then go lower, we're no longer maybe enjoying the casual 5% that's in a highly liquid, high yield savings account, let's say. So if we're not so lucky anymore in getting an easy 5%, then that's where some people could be relocating their money. But I haven't really thought about that too deeply. Like I'm a little bit less interested in doing that only because I want to have my money be more liquid. So I want to be able to readily use it, even if, let's say, rates start going down to 4.5%. I'm still okay with that. That's not too bad. But if it were to drop to, like, let's say a black swan event happens and it goes from 5% to 0%, they'll be like, oh, I guess I might as well invest in the stock market then, because if I'm going to go from 5 to 0, like my money is not earning anything at 0. So I might as well invest. There's no incentive to leave your money in a bank unless you just are afraid and you need like a cash cushion, even if it's not earning anything. So it really depends on each individual circumstances. Just because there's something I would do doesn't mean it's the right action for someone else. Everybody has to evaluate their own financial circumstances and make the best decision they can given the cards they're dealt. So I'm just saying what I would do. So definitely this is not advice. And just because I do something, I could be super wrong. Like the stock market could crash and then it's a super bad idea that I invested a lot of money in some stock lately. I could be ruining that decision someday. So just because I'm doing something doesn't mean it's right. So I want people to know that you try to make the best decisions you can with the knowledge you're given, and you try not to have regrets later. But, with some things working against the stock market right now, like I think I saw a headline in Wall Street Journal saying that only a few big tech stocks are propping up the stock market. Like, imagine if only Apple and Microsoft and Google and Nvidia are propping up the stock market right now. That's pretty scary that, let's say, 496 companies in the S&P 500 in theory could either be just kind of going in the middle, like they're not really going up, they're not really going down, or a lot of them are going down, and it's like for all the Nvidia keeping the market up, there could be a bunch dragging the market down. So you're using a very few amount of stocks to keep the market even sort of positive for the year. So I kind of think that there are some warning signs. Also, if we look at the Dow Jones Industrial Index, that's only up like 2.5% this year, year to date. So I feel like there could be some warning signs if you look at some of the stocks that also make up the Dow, is that a lot of them are not doing that great. So if we think about that, there could be a lot of warning signs in the stock market in general that should give us pause about just blindly investing without knowing what we're getting involved with.
If you're getting 2.5% on a stock, I know you said it was the index and it was an average, but and that, certain companies were the drivers, they are actually the drivers of what drives the market right now. So do you want to put your money into a stock that's yielding 2.5%, or do you want to put your money into maybe a potentially shorter term bond that's yielding 5%? That's something you have to think about also right now. And the thing that Michelle talked about also earlier was that, she was investing in a business that she believed right now, during all her investigation into this business, believes it's a wonderful business. Using Warren Buffett terms, she's calculated a price which she finds, I could get this stock at a reasonable price. So what Michelle is doing here is also she's buying with that margin of safety that gives us a cushion. First of all, if you made any errors when you did your case, Michelle, or what potentially could happen. So either she doesn't lose much, or the stock price will increase because she invested at a time that, showed to be a fantastic time to invest in that particular business
Well,
because it's going through some rough time.
and I just want to add, it's not because it's the timing. So I just want to caution people about when we say timing, like it just so happened that the stock cratered after a bad earnings call, and I recognize that opportunity of the price is low relative to what I believe the true value of this company is. So it's not about timing the market, and I just wanted to make that clear of I'm not trying to time the market. I just saw that this is a cheap price for a wonderful business, and that's what I pounced on of like, I think this is giving me some margin of safety. I don't know if the business is truly 50% off or if it's at whatever discount to its real value, but I think it is at some discount. And that's what I'm judging my calculations and research into the company on. So I just want to make that super clear. That's why I'm sorry I jumped into what you were saying.
Yeah, and it's a super important point, that you're not timing the market, but that doing an actual qualified uh, move right now into you're not speculating that the stock potentially hit bottom and you're going to sell at the top or anything like that. It's making yourself ready to invest in a business. And I'm in the somewhat same position right now. I did not invest in a stock right now, but there is one of the businesses that I've been looking into that's going through some rough times right now. There's some news that came out which made the stock price fall, and there's an earnings report coming out soon, and analysts believe that this particular business maybe is, stagnating a bit, and where I'm like, I understand what's going on right now. I understand what is happening, and hopefully, the price will go down even further so that
Hmm.
I can purchase some shares. But I am waiting a little bit because it's not quite trading at the discount that I would like to see. The stock is trading at a margin of safety where I've been actually looking into this business for a while. I know the price range I would buy this stock for in case that the stock price would come down to that particular price, because I understand what's going, the company is going through. And I also believe that it's short term, and some indications of what is going on right now. And that is also that it's also changing soon. So yeah, whole lot
Oh,
of
that's
words.
great. I mean, I'm glad you are staying patient and you're sticking to the process. That is one of the keys here is that you stick to an investment strategy that works for you, and that's all that anybody can do. Like the only time where people get in trouble is where they're flip-flopping between strategies and you do one thing and then you get scared and then you try another thing and then it's like a lot of errors that are unforced in tennis terms. And you don't have to do it if like no one's making you invest. So you have to just try to take a step back and think, am I making the right decision? And waiting could be the right decision. So sometimes people feel like they have to do something like, oh, I'm missing out on gains. Like my neighbor is getting rich and I'm just sitting here like a dum dum. But we can't talk to ourselves that way. We have to just stick to our own game of what we're doing in either trying to invest or save money for now, whichever is the most right for you. And, some people in the media have called this the everything bubble. And it's kind of felt like we've been in an everything bubble for years. Like there are so many things that could be at risk. And because yields had been so low for the longest time, everything else was going up, like housing and the market. And, it's been tough for a lot of people to buy houses right now. And even with higher mortgage rates, it's still tough to buy real estate. So the interesting thing is like it makes you wonder what assets will deflate at some point if interest rates were to go down, because could that be a true reflection of the economy really slowing down, or is everything really fine in the economy and then kind of like the market is just kind of being allowed to be a junkie. If you keep giving the stock market and real estate market low interest rates, that'll be juice for it to just jump up even if that valuation is not warranted. So it kind of makes me wonder, if the Fed lowers rates, is that a true reflection that the economy actually is slowing down and then some businesses will fail, some people will lose their jobs? Is that really what's going to happen? Then some people will struggle to pay for their expensive mortgage payments that they've now committed to. There could be a lot of home buyers' regret in the coming months if it's true that the economy is slowing down. So some people could be jumping for joy as soon as the Fed cuts rates, but there would be some people who will suffer. So, I mean, just keep that in mind of like, you would think the Fed is doing the right thing. So if you're lucky, if you're not losing your job and you have enough of a financial cushion, you could be in an opportunity to take advantage of certain trends. But for other people, there could be some scary things on the horizon. So that's something to keep in mind. I don't want to end on a slightly gloom and doom note. So we just have to do the best we can. We should be aware of financial trends and the news, but we shouldn't let that scare us into kind of paralysis, because that could also happen of where you're not sure what's going to happen, so you do nothing. And I want us to feel like we have options. Like, people definitely have options, and you definitely can do things to have more income streams. Like, if you start a side hustle, or you get into investing, or you save money, or you're able to figure out different ways of earning more income, that's what you can do to try to prepare yourself no matter what happens in the economy. And Sina, do you want to close with any final thoughts?
Yeah, I was thinking, just as you mentioned earlier, even though, there might be certain stocks right now that's driving the market, like don't speculate in that. And then there's, always going to be offers out there, great quality companies go on sale, and that happens all the time. It's just a matter of finding something that's within our circle of competence that we can look for. So, no matter the market condition, there are great offers out there to be found, and you need to use some good, clever thoughts about investing and take advantage of the situation right now. Again, what we talked about, looking back, to find some high yield bonds that is an opportunity right now, low risk, or find businesses out there on sale, or start doing your homework right now to find those businesses. So when it actually happens, that you can go jump on the opportunity. All right, so we're done for today, but we'll be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.